Hello, my dear students. We take up the next chapter, which is valuation of goodwill. Now, you've already got the introduction and the basics of the chapter as we've discussed in the class. So, furthermore, I'll be carrying in my lecture about the details of the chapter. Now, it is one of the parts and portions that we need to learn for our next portion of partnership firms, that is for the admission of a partner. Now, as I've already said, that valuation of goodwill is required into the business, because when you are drafting the books of accounts for a partnership business, goodwill plays a very, very important role, because more so it is seen that while a partner is leaving the firm or a partner is joining the firm, goodwill is one such aspect which actually is taken into account to distribute the accumulated profit, to distribute the adjustments and pass on the adjustments in the partner's capital account. So we will get to know about the valuation of the goodwill. Now, valuation of the goodwill, as we'll discuss on page number in around 2.5, you will find methods of valuation of goodwill given. So under that, you have got three broad categories: average profit method, super profit method, and capitalization. Now, first and foremost, we begin with simple average profit method. A simple average profit method, what you're supposed to do is every year you will be taking up calculating the normal profit, and then you will be adding up all the profits given in the number of the years that have been given. You will find out the average. We all know how to find out the average, isn't it? Sum up the total profits, so divide by the number of the years for which the profits have been given, and you get the average profit. Now, goodwill, as discussed in the formula, is calculated on the basis of number of years of purchase. That is, for how many years you will be considering goodwill to be existent in your firm. So whatever average profit you get the answer to be, multiply that with the number of the years, and you get valuation of goodwill. Now, the only twist over here that you might face in certain problems is that each year they may not give you the direct profit or the loss. What may give you is, for a particular year, they can also give you certain adjustments, leading to the fact that could be you've missed while recording or calculating the profit a certain expenditure or income. So in that case, if you have missed a certain expenditure to be incorporated, then deduct it from your profit, or income, then add back in your profit, right? And you get the correct profit. Or maybe another popular one is abnormal profit and abnormal gain. Now, abnormal profit generally doesn't happen, so you got to deduct it, right? I repeat, abnormal profit to be deducted, and abnormal loss, again, it generally doesn't happen, so you need to add it back. So abnormal losses will be added back. So each in every particular individual year, whatever normal profits or losses or abnormal profits or losses that you get, you will be adjusting that and land up calculating the correct profit for each year. Then you will add up, find the average divided by the number of years, so you will be getting the average profit, and of course with the number of years of purchase, you will be getting the valuation of goodwill. You can have a look at illustration 3. There also adjustments have been given. See, it has been solved in a tabular way. Year ended profit, then adjustments of 10,000, 30 and 10,000 for all those 3 years have been deducted, added and deducted subsequently, and you found out that the average profit after dividing 6,60,000 by 4 comes to 1,65,000. So that is 1,65,000 into number of years of purchase, so 4,95,000 is the answer, right? So that's simple average. What about weighted average? Weighted average is this entire mechanism taken into account. The only thing is that you'll be given weights for particular years. So if you can just have a look at, say, the illustration 8, weighted average, right? So if you can see that under the solutions given, year ended, profit, adjustment, these 3 columns are same, there's no change, right? You will be drafting all these 3 columns. So once you calculate the correct profit of each year, then whatever weights have been assigned, generally those are 1, 2, 3, 4, 5, starting from the previous most year till the current year. Okay, so starting from the past year till the current current year, because of course the weight of the latest year is most compared to the other past years. So weights will be written simultaneously. I'm sure you're referring to illustration 8 again and again while I'm saying, because I'm talking about illustration 8, the second part of the solution. So weights are given, then product of the profit and the weights are calculated, and then they are summed up, which is coming up to 21 lakhs divided by 15, and you get 1 lakh 40 as the average goodwill, and that multiplied by the number of years into 3. So the answer is 4 lakh 20. Okay, now the second important method is super profit method. Most of the sums you'll get that. Super profit method, the very important first component is capital employed. Okay, before I go into it, I will repeat again, there would be number of classes that we will be devoting to goodwill calculation and valuation, so nothing to worry. The audio lecture is not just wrapping up the chapter, or this is not the only place that we are doing the problems. This is just a backup for all those times when we are not having the live classes, right? You can always fall back upon this for your reference. So capital employed, the first important content. You have two approaches to calculate capital employed of a firm: assets approach and liabilities approach. You've got that example given also. That's a good example. We'll discuss that in the class. You can read it also before we can do that in the class. Assets approach will deal with all the assets, and you will deduct fictitious assets, goodwill, and outside liabilities from that to calculate capital employed. And liabilities approach will be with partners capital, you will be adding reserves minus fictitious asset and goodwill if there any, and you will be getting capital employed. After you find out capital employed, then you will be finding out normal profit by applying normal rate of return of the business. What's normal rate of return? Like generally, how much profit percentage does the business have? And this profit percentage is expressed upon capital employed. So if somebody says 10% normal rate of return means 10% of the capital employed. Pretty simple. You will just find out the percentage and say, suppose capital employed, like if you can see in illustration 12, like you calculate generally the average profit like we've done in the past two methods. Here also, incorporating the adjustments, you found out the average profit to be 2,17,000. Now capital employed is already given, normal profit rate of return is already given, so normal profit will be 10% of 15 lakhs, which is coming to 1 lakh 50. Now the most important step, what is super profit? The excess of your average profit earned over normal profit, what you could have earned. So that is 2 lakh 17 and 1 lakh 50 in this case. You're getting 67,000 into number of years, that's 3, and your answer is 2 lakh 1,000, right? Not to worry, we'll be taking 2 or 3 more other illustrations for calculating capital employed and so on, right? Nothing to worry. Then the last one, you've got capitalization method. Now the capital employed will be remaining static, normal rate of return will be remaining static in all that what we learn, isn't it? Capitalization method being the last method, further categorized as capitalization of average profit and capitalization of super profit. Okay, now these terms are already you well versed with. What is average profit? What is super profit? We've been doing that in the chapter so far, isn't it? We've done illustrations in class also. So here what will you do is, what do you mean by capitalization? If you see illustration 18, that is capitalization of average profit. Now the firm has earned 60,000 profit, normal rate of return is 10%, assets 7 lakh 20, liabilities 2 lakh 40,000. So if you are supposed to find out capitalization, see the solution. Total capitalized value will be average by normal profit rate of normal rate of into normal rate of return. That is see, if normal rate of return was given, you could have calculated normal profit. We are doing back calculation. So average profit by normal rate of return, and it is 60,000 by 10, so that's coming to 6 lakhs. Now what are the total net assets of the company? 7 lakh 20 minus liabilities, so that's coming to 4 lakh 80. So goodwill will be total capitalized value of the firm, which you've calculated as 6 lakhs minus 4 lakh 80, that's coming to 1 lakh 20. Okay, likewise the same almost have been taken in illustration number 20. So you can have a look. Because this was simple average method, so it's just one formula to keep in mind, that capitalized value of the firm is average profit by normal rate of return into 100. Formula is there in your book, sums are there in your book, nothing to worry. The last one, capitalization of super profit. We already know how to calculate super profit. The only thing over here is that if you can take up illustration 21, there capital employed, it according to assets approach is 14 lakhs minus 4 lakhs coming to 10 lakhs. Normal profit is capital employed into normal rate of return. We have done all this in the previous sums, in the previous portions, nothing to worry. So that's 1 lakh. Then super profit will be equals to average profit and then minus normal profit. So that's coming to 1 lakh 50 minus 1 lakh, and goodwill is equals to super profit by normal rate of return. So that's coming to 50,000 by 10, that is equals to 5 lakhs, right? So that was illustration 21. Now what I would ask you to do is refer to illustrations 24 and 25, because they've given us a total amount of data, and then they have asked us to calculate goodwill on all the 4 categories. So you will be calculating that, you will be going through the illustrations, nothing to worry. On the basis of this lecture, you'll be carrying forward the details in the class and wind up the chapter there. Thank you.